Doing great today on a Friday, July 28th. Welcome everybody to another Capital Gains Tax Solutions Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, and not having a plan is the enemy. And using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated assets, defer capital gains tax, so you can create and preserve more wealth and unlock the freedoms that you desire. Hey, my name is Brett Swartz, and for those who don't know me, I'm founder of Capital Gains Tax Solutions. And every Friday, we come together, 5 to 15 to 20 people every Friday, to discuss ways to exit, to discuss maybe your live deal, to discuss a deal that you're working on for one of your clients. And so we try to demystify this thing called a deferred sales trust, so that you can take action and you can exit very well. And so today we're talking about 7 reasons tech entrepreneurs should use the DST for their multi-million-dollar exit. And so let's start with this. Tax efficiency, right? So the very number one reason to use the deferred sales trust has to do with the ability to defer the capital gains tax on the exit of the asset, whether it be a C Corp, S Corp, LLC, or you're with partners. If you're selling your tech company, you may have a huge gain. And a lot of tech companies, they don't necessarily have a lot of depreciation, just a huge gain, right? You might be going public. You might be bringing in a joint venture partner who's infusing capital, or an angel investor who's going to help you seed the next round of growth. And so the tax efficiency is so important here, because with the deferred sales trust, instead of having to pay, let's say 25 to maybe 40% of that capital coming in tax, especially if your basis is zero or very low, you're going to be able to efficiently use the wealth to build more wealth. And so the deferred sales trust allows tech entrepreneurs to defer their capital gains tax that arises from the sale of their business. And again, instead of paying that lefty sum up front, the taxes are spread out over time as you receive payments back from the trust. For those who are learning about the deferred sales trust for the first time, it's an installment sale. It basically says, hey, look, we'll buy your business before you sell it to the ultimate buyer if you finance the trust, and then slowly the trust will pay you back over time. In other words, you're becoming the lender or the bank. Instead of receiving all the capital up front and paying the tax, you're deferring that capital from being received. Therefore, you're deferring the tax. It's kind of like an IRA and a 401k as well. And so number one is tax efficiency. What's the number 2 reasons why tech entrepreneurs use the deferred sales trust for their multi-million-dollar exits? And that's investment diversification. Investment diversification. And diversification, I think, is a great way to capture your wealth and or preserve your wealth, especially on a huge exit. Maybe you poured blood, sweat, and tears into this tech company for 5, 10, 15 years. And this is maybe you poured your entire net worth into the business, right? You maybe took on debt somewhere else. Maybe you took on other investors' money to get it going. And now you're hitting it, you're doing very well and you're exiting and you're having a big payout. Well, guess what? Not only do you want to defer that tax, but why don't you diversify that wealth? And so the deferred sales trust is a beautiful way to do this, because the investment class is not singularly focused. It doesn't have to be just real estate or just stocks or just securities or just insurance or just cryptocurrency or just other business ventures. In fact, it can be a mixture of all of these. And so the deferred sales trust can be invested in a variety of different assets, like real estate, like crypto, like other business ventures. And this allows you as the tech entrepreneur to diversify your portfolio of wealth, reducing the risk associated with holding all of your wealth in one asset, be it that your business that you're selling, or be it that the piece of real estate that you might own, or if you're listening to this and you own cryptocurrency. You want to make sure that you're able to diversify that wealth, which leads into the 3rd reason why out of 7 tech entrepreneurs should consider the deferred sales trust. And that has to do with estate planning. And so estate planning is I feel like it's a little bit of a bonus when it comes to the deferred sales trust, because most people think of it like, look, I can defer capital gains tax. I have some diversification to grow my wealth. But what's neat about the deferred sales trust for estate planning is that it establishes essentially a place where all of your assets, if and when you do sell them, can go into the trust and you can get a promissory note back. In other words, they can consolidate so that it helps to manage the transfer of the wealth to your heirs. And I'll give you a couple stories for this. I helped a client sell a multifamily property in Folsom, California. He also owned a large kind of a duplex in San Francisco overlooking the San Francisco Bay. And for him, the biggest challenge was he had 4 kids and each of them had different intentions or different thoughts and different levels of motivation with the wealth when it was going to be passed to them. And so for the dad and the mom who were still alive, still owning the asset, it was a little bit more challenging to manage because A, they didn't want to pay the capital gains tax if they sold. B, they didn't necessarily want a 1031 exchange it to something else. But C, they also didn't want the kids to have to, let's just say, debate or be in an argument and post when they pass away. They wanted peace with the family. And so the deferred sales trust allows them to do is to sell the apartment complex, sell the primary home, sell the investment property, sell the business. In other words, consolidate into the trust, established in a living trust outside the living trust. The promissory can go inside of that, and it just simplifies the potential conflict with the heirs. Okay. And number 2 part of the estate planning is the ability to move funds outside of your taxable estate. So if you're selling a 50 or $100 million tech company, you're looking at not only a capital gains tax challenge, but you now have moved yourself into an estate tax challenge. In fact, those numbers aren't even, they're going to be even lower than that coming up in 2026. Essentially, if you're about 6 million single as of 2026, you don't only have a capital gains tax problem, you have an estate tax problem. And so what you want to do is look for ways to eliminate that estate tax by moving the funds outside of your taxable estate. And we have what's called the DST 2.0 that allows you to do that in a powerful way to help with your estate plan. Okay, so we've covered 3 out of the 7 so far, right? We're talking about 7 reasons tech entrepreneurs should use the deferred sales trust for their multi-million-dollar exit. Let's talk about reason number 4, which is cash flow management. Through the DST, the seller can structure the income stream according to their financial needs and goals. This is so important to understand. This value of the deferred sales trust is the ability to delay income for a period of time until you are in a more tax efficient situation. For example, if you're selling your technology business, a lot of times it's a form of an earnout where they want the founder, they want the partners to stay on for a period of time to make sure the transition goes well and to make sure you hit projections, right? And so typically that's maybe a 2 to 3 year type of term. And during that 2 or 3 years, you're still getting paid by the business and you're still getting a substantial income. But guess what? In year like 2 or 3, when you officially exit that business, you're essentially out of a job, right? Which, guess what? We can turn the deferred sales trust income on and on that date. We can schedule it, pre-schedule when the payment will come on, and that'll help you to be more efficient with your taxes. In other words, the trust, let's say you sold a $10 million business, it owes you $800,000 a year, plus that 10 million. You can delay that 800,000 for a couple of years until you start taking payments. Do you actually pay the tax? And or some people want to move out of state. They might be moving out of California or New York or New Jersey or on Illinois, and they're establishing a residency in a little more tax efficient state. Well, the state in which you receive it in, this helps you to manage your cash flow. I also talk about the tax flow management. Is really what to think about. It's not just cash flow that you're receiving. It is the tax flow that you're paying, right? In other words, you want to manage your overall income stream by lowering your taxes as much as you can by being efficient. So the deferred sales trust offers a flexible way for entrepreneurs who may not need immediate liquidity right now or income right now and prefer a steady income stream over time or starting at a later date to help them manage their cash flow management. Okay, so we've covered 1, 2, 3, and 4, tax efficiency, investment diversification, estate planning, cash flow management. And we're going to round off these last 3, which are risk management, potential for higher returns, and flexibility and control. So risk management for an entrepreneur, I think, is huge, right? Because as an entrepreneur, especially if you're in the tech industry, you've taken an enormous amount of risk on something that maybe wasn't proven or something that you created from scratch. And that risk now has paid off. And so now you have an opportunity, should there be a downturn, to be able to sell at a good price, a good multiplier, and essentially move the funds into a position to be able to regroup for new opportunities. And I'll use the cryptocurrency client that we worked with who did this for Bitcoin. In fact, she worked for a big tech company in the Silicon Valley. And for her, the biggest challenge was she bought the Bitcoin for 50,000. It went to 50 million. She never sold a coin until she met us. And the thing is, she said, Brett, I didn't want to sell because of the biggest thing that was the tax. But number two, I didn't quite have an amazing place that I felt great about to go into until I decided to start a company with my college roommate on how to help educate kids online, sort of like a Khan Academy style environment. They wanted to create this from scratch. And so she had a vision and a goal for the cash. Now she needed a plan to exit and have that flexibility and control, which is actually kind of part of number 7 here. But also is managing that risk, because guess what? Cryptocurrency can go like this and it can go like this. And maybe we're kind of on an upturn. It looks like we're around 30,000 a coin right now, which I think is really interesting. And Ethereum is actually making a pretty good run here as well. But the point of this is she was able to manage her risk with the big gains. Now she sold about 54,000 a coin. We exited $5 million in one day, deferred about 2 million of tax. And then she was able to invest the majority of that into a tech startup. And guess where Bitcoin went at that point? Well, it went from 54,000 to 68, but then it crashed down to, I think the low might have been like 10 or 12, maybe a little bit lower than that. Now it's up to 30. But the point was she was able to manage her risk of that investment by being able to exit well and then diversify the wealth into a tech startup, which is actually the best part of this story. She's able to retire from the big tech company, but more than that, use the capital from the big investment into crypto via the deferred sales trust to fund the next business venture. We call this the go fund yourself, rather than having to get seed capital from a venture capitalist and or from a bank, capital. The trust that owes her the money was able to partner with her to fund it. And so it's a really cool thing. It's kind of like we call it the go fund yourself. All right. So that's risk management. We're rounding the last 2. It's number 6, potential for higher returns. So the deferred sales trust offers the funds within the DST to be invested in a broad range of assets and potentially yield higher returns than what the entrepreneur business was generating. In other words, a lot of the tech companies, maybe even yours, if you're considering selling it, perhaps it has a huge multiplier, but the cash flow may not be exactly where you'd like it to be. In other words, it feels like maybe it's really we call it asset value rich, right? But a little cash flow light. And so how do we unlock that capital that is ready to harvest and replant it into assets that can produce higher returns, higher cash flow, which ultimately could unlock the time freedom, the passive income freedom. And that's the neat part about the deferred sales trust. It can go into real estate, multifamily investments. It can go into mobile home park investing. It can go into self-storage, industrial properties. It can go into some of the biggest, dividend paying stocks. It can go into T-bills, right? Around 5% right now, or money markets, even at 4.5%, 5%. It can go into things that potentially can increase your return. We have a deal story for this. A client of mine out in Sacramento, California, sold a 15-unit apartment complex. Their NOI, net operating income, was about $120,000. And then we took about $120,000 divided by about 2.3 was after the exit cost, closing cost. That's what's called a return on equity. And we said, well, what if we could earn on that same amount of equity by redeploying it into other assets, somewhere around $180,000 to $190,000, right? So that's an increase by about, $70,000 of cash flow. What would that mean for you and your family? Let alone no more toilets, trash, liability, the increase in insurance costs, interest rates that are going higher, and fixed rate loans that are adjusting. So they were able to get higher returns while lowering their risk and also freeing up the most valuable asset, which was time. So potential for higher returns is a big part of the deferred sales trust, which leads us to the number 7 reason tech entrepreneurs should consider using a deferred sales trust for the multi-million-dollar exits, and that's flexibility and control. As an entrepreneur, we get it. We're entrepreneurs ourselves. We want to be able to do deals and invest into ideas that we love, right? And have the ability to do that at a speed and efficiency that doesn't hold us back. The best part about the deferred sales trust compared to, I believe, just about any other tax deferral strategy is that ability to do just that. You can keep the funds liquid until you're ready to strike. We call this the keeping your powder dry until the deal makes sense, until your idea is ready to, grow, right? Until you have everything lined up. You can use the deferred sales trust the next day to fund your next deal, right? We do this through a joint venture partnership with the trust, the way it's structured, where you are the managing member of a new LLC. In other words, you're in the control of that LLC. Now you owe the money back to the trust, which owes you the money. So it's a bit of setting up. We do have to take some time to structure everything the proper way. But as long as it's business purpose or investment purpose, you have the ability to have that control. Now, as the trustee, that's our role. I also want to talk about the other side of control. And it's one of the biggest hangups people have to get comfortable with. Hey, who's the third party trustee? Am I giving up some control? You absolutely are. Remember, you sold your asset to the trust. If you had unilateral control, it'd be taxable, but you can turn around and partner with the trust to go buy and invest into your deal. So let's walk through this area of control. Let's say you had a $10 million exit and you're in California, Silicon Valley, and you're about to pay $4 million of tax. You can choose your control. You can have $6 million of unilateral control, pay your tax, and you can do whatever you like with the $6 million. Or you can choose to have indirect control via the deferred sales trust with the full $10 million owed back to you. And then that does what? Well, you can partner with the trust, form an LLC, and go start that next business venture. So let's start over again. Let's imagine you have $6 million that funded your next business venture. Well, why don't you use the deferred sales trust and have all $10 million in there and have $6 million fund the next business venture? But guess what? Have an extra $4 million invested in some of the biggest companies in the world. Maybe diversify with Microsoft and Google and Apple and Home Depot and Costco and all NVIDIA, all these different ones. Maybe some into crypto, maybe some into real estate. In other words, there's an extra $4 million opportunity to work for you and to earn. And this entire time, this is all tax deferred. Partnering with the trust is still tax deferred. And that's the beauty of the deferred sales trust. So the deferred sales trust offers the entrepreneur a significant way and a significant say of how the DST is structured, including the payout terms and including the investment strategy. And that is so important. So that wraps up the top 7 reasons a tech entrepreneur will use the deferred sales trust. If you want to take action right now, you can go to capitalgainstaxsolutions.com. We're going to open it up for questions from the wide range of groups that are with us. In fact, I'm going to first call on Jake Carpenter. He's one of the financial advisors, top ones in the country that we work with. I love Jake because he's not only a financial advisor, securities professional, but also he has a great deep understanding of real estate and access to deals. Jake Carpenter, any thoughts on anything I just said? And I'd love to see how you're doing today, this Friday.
Doing great. I'm happy to be here. A lot of good information that you covered that was very relevant to a lot of the decision-making process for our clients. And probably the only thing I would add is that, control really is the thing that I think is desirable to most of our clients, because control goes beyond just controlling the capital, but it also has to do with being able to control how active or how passive they are with the assets and investments inside the trust. So let me give you an example of that. Brent and I just did a deal here not too long ago where this guy was very, very active. So he was very hands-on. He took advantage of that, and he took a small investment and inflated it to a large amount of gains. And then as he used the deferred sales trust and as he worked with us, he kind of decided, I really would like to hit pause for a couple of years and just kind of sit back and enjoy the fruits of my labor before I go back into a direct, actively, or at least have the decision to go back into actively working and doing the deals. And to a large degree, everyone has the ability to take, their entire real estate portfolio, sell it off, defer the capital gains, put it in the trust, and you can be passive with half of the proceeds and active with half. You can be passive with 25% of the proceeds and active with 75%, but you really control the dial when it comes to how active and how passive you want to be. You control the 3-dimensional diversity with what asset classes you want to invest in, from stocks, bonds, mutual funds, the large companies that Brett talked about, or real estate, income producing real estate that could be active or passive. So there's many, many ways to be passive or active and have really a lot of control, even though you don't necessarily technically have direct control. You are working with a friendly trustee, Brett Swartz, who's been a joy to work with over the last 6 or 7 years, who wants to make sure that you're continuing to be able to do the things that you want and need to do.
Very well said, Jake. Thank you so much. Very well said. Appreciate the kind words as well. And so, yes, the deferred sales trust does give you that flexibility of being passive or active, right? Being retired or being that entrepreneur, compared to some other asset types that are more challenging, right? If you're in a 1031 exchange, yes, there is something called a Delaware statutory trust where you could be retired. But typically those are held to 5, 7, 10-year holds, illiquid, absolutely zero control, zero liquidity, zero diversification. And those are great because it maintains what's called a stepped up basis, and they're tried and true 1031s. But a lot of these deals aren't value add, and the returns are, modest to say the least. And so you're sort of like locking in your destiny for the next 5, 7, 10 years. And I just know for myself and a lot of my clients, we want the ability to go back into deals when it makes sense for us, or be retired across multiple assets. In fact, working with a seller right now who's looking at the Delaware Statutory Trust as an option versus the deferred sales trust, and a bit back and forth on both sides. And so the Delaware Statutory Trust, it provides that tax deferral, right? But it also gives an old basis, right? Old basis isn't great. Whereas the deferred sales trust, you can literally go into that same investment and have a brand new basis if we structure it properly with a joint venture partnership, and taking the extra step with the trust. Yes, the trust is more expensive. Yes, it's more complicated for sure compared to a 1031 exchange. But at the same time, anything that's new tends to be more complicated. But once you are, riding the bike, swimming with the deferred sales trust, it does become more comfortable and become more natural. But essentially, you're a lender lending to a trust that gives you the ability to take payments over time, pay tax slowly, but also partner with the trust to invest in different assets. And so that is some more about the deferred sales trust. Again, if you want to take action, you can go to capitalgainstaxsolutions.com to learn more. And I'm going to open up for other questions too. For anyone in the audience, you can put it in the chat, or you can also unmute yourself. And if you're curious how to be on this, you can go to capitalgainstaxsolutions.com. We're also live streaming this on YouTube as well, but all of the questions will be here in the Zoom meeting. So does anyone have any thoughts or questions at this point? You can unmute yourself, say hello, introduce yourself, and we would love the opportunity to help you out or answer any questions you have. And I'll keep talking. No problem. Hello, Keith. Wait, maybe Keith unmuted himself. Maybe. Keith, are you there? No, he's not there. That's okay. All right. So I'll keep going. What else can we talk about here? Jake, let's see, we talked about a couple deals, live deals we have going on. Maybe you can talk about some of the objections or the questions that have come up recently. Is there anything you would say is a theme lately as it pertains to using the deferred sales trust, or objections or concerns that someone might have that we can kind of we'll toss up our own objection and then we'll answer it?
To respond to that?
Yeah, there you are.
Yeah, so probably one of the biggest ones is my CPA hasn't heard about it, and he's the best CPA in the country. So obviously, it may be something that I shouldn't consider. And so let me tell you a lot about the CPAs. The CPAs kind of stick to what they know. And this is the reason why there's value in bringing in a team like myself, Brett Swartz, some of our other strategic partners, because what we do is we come in and we work with the financial planners, the CPAs, the attorneys, the real estate brokers, to go through a very detailed due diligence process. And this due diligence process is very, very important, because not only does it help you as the seller understand what you're doing and why you're doing it, and the options and the flexibility and the fees and how it works. But it also gives you the ability to introduce your professionals to a strategy that, most of the time, if you're in the right situation, and we'll talk about that a little bit down the road, but if you're in the right situation, you've got the right amount of gains trapped inside of your transaction, it is very powerful. And so I actually had a guy who Brett and I are trying to set up a meeting with right now, who had reached out to me, who said, Jake, I want to thank you for suggesting that my attorney and my CPA be involved, because I know that is what's going to help me protect my own interest. And I said, absolutely, and I said, I will tell you, and I'll call him Bob. I will tell you, Bob, it's a little bit of a kind of a, something that's more for me than for you, because yes, we want you protected. But at the same sense, when Brett and I and the tax attorneys talk to their CPAs and attorneys, we oftentimes end up picking up a new strategic partner to give us referrals, because they think it's amazing. The light bulb goes on and they go, oh, this is nothing more than an installment sale. IRS code 453. I get it. That makes sense. I've got other clients that probably need to look at this.
It's exactly right, Jake. And that's why we invite everyone, and we do a no cost, no obligation due diligence, kind of fact finding and answering questions. There's no bad questions. It's just, you keep asking the questions, we keep answering them. And so, but it is interesting for sure to see let's say the adoption of this, right? The adoption, although it's been close to 30 years now, thousands and thousands of closes, billions of assets have used it for sales. And it's never had a change on any of the audits, over 24 audits, right? State and federal, most of the deals in California. And it's literally batting 1,000, yet it is emotionally difficult when you, as either the tech entrepreneur selling, or a real estate owner, or whomever, someone has helped you build and manage your taxes for many, many, many years, you're approaching the subject and they don't know about it, right? It's almost like, oh no, maybe I'm skating on thin ice. And so some of the things that we encourage you to do is, number one, research it together. Bring your CPA along with you in the passenger seat. Don't have them in the rearview mirror kind of catching up to the due diligence. Literally bring them on the calls with you. Pay them for their time and their energy to research it, to do the best they can. If your CPA is unfamiliar with it, it's really an opportunity for both of you to learn about the deferred sales, just like Jake was saying, as the financial tool, as the tax referral tool, and then share resources, because guess what? It's not just the strategy that we set up in a tax deferral, but it's also how it affects your individual tax return. So we want to weave the DST as a part of your overall tax plan. Your CPA does all the tax, income tax and business tax returns. The deferred sales trust has its own tax return. You get a 1099 INT on any payments you've received. And then if you receive principal back, you'll also report that principal. And so we do always want to work with your CPA. However, we encourage you to that your CPA, just because they're not familiar with it, it doesn't mean it hasn't worked every single time. By the way, the creator of the structure is a CPA. We've also found that most CPAs don't necessarily want to hear from anyone but other CPAs, which totally makes sense. It's kind of like, a doctor, brain surgeon who's about to do surgery. He's not likely to talk to a layman about the technicalities of the surgery. You're going to want to bring in another brain surgeon. So we have the tax attorney CPA who created the structure. That's the law firm we work with, and the CPA firm. So they're wonderful. Number two, seek a second opinion, right? So not just your own CPA. If your CPA is, I guess, more negative or a little more closed-minded, or too busy to do the due diligence, or not interested, right? Or just negative on the entire concept, don't throw the baby out with the bathwater. Go seek a second opinion. In fact, we have other third-party CPA firms, other third-party law firms. In fact, one of the deals I was working on, the buyer ended up not actually buying the deal, so the sellers held on to the business at this point. But he went through the entire due diligence process. His CPA even actually felt pretty good about it. But he said, I'm still concerned, Brett, because everyone I'm talking to, it seems like it's all just positive. I like to seek even a second opinion or a third opinion. I said, great. He says, I'm going to go find that person. We should, no problem. So he found a former IRS agent who's also a tax attorney living in California. And that gentleman did about a 3 to 4 month due diligence, signed all of the NDAs, and this particular potential client hired him, paid him, I think, around $10,000 to provide what's called a private legal opinion, right? Just a legal opinion. And guess what? He went through all of the due diligence with us, with the tax and legal firm. And he said, thumbs up, green light. I don't see any major issues or risks here. He laid it out in a full opinion letter. And he said, do the deal. So seek that second opinion. Just because your first CPA says no, may seek a second one, or even connect with us. We'll provide you with some third-party groups that you can connect with. The next one, I guess, would be consult those who are doing the deferred sales trust, right? So work with us, as well as talk with our clients who have done due diligence, who have, advanced CPAs, tax attorneys who have done due diligence with them. They've done a lot of the heavy lifting. I've had clients, they didn't close for a couple of years, right? Partly because their deal wasn't ready to close yet, but also partly they were doing their due diligence. And so seek out the professionals who are doing these on a daily basis. This is what we're doing on a daily basis as a trustee at Capital Gains Tax Solutions, but working with CPAs and tax attorneys always to help them educate on that. That being said, any thoughts or questions from anyone else? Jake and I have been talking quite a bit. I think we do have one actually here from you said Eula. Hello, Eula. How do you set up that trust? You want me to talk about just how to do the DST, or do you want to unmute yourself and just maybe expand upon that? Do you have like a scenario we can kind of run by? And if you don't, that's okay too. No worries. I can just talk. We'll talk about how to set up the deferred sales trust. There's a couple steps. It's actually pretty simple. You could choose a name. First of all, let's say you live in Scottsdale, Arizona, right? And you say, I want to call it the Scottsdale 2023 Trust. Fantastic. And by choosing the name, now we have a placeholder for how to form the trust. Think of it sort of like forming an LLC, working with the tax attorneys and with Capital Gains Tax Solutions at no cost, no obligation. We have a name for the trust, and then the trust is formed. There's an EIN established for it. By the way, there's all kinds of different trusts out there. Ours happens to be a business trust. There's also living trusts. These are different trusts, right? But this is a business trust. It's sort of like a brand new business entity, kind of like a C Corp. And this business trust, now that has an EIN and has a name, raises his hand and says, hey, would you like to sell your business to me in exchange for a promissory note? You typically finance the trust 100%. And upon the sale of the asset, you receive a promissory note, and the trust, typically in the same day, immediately sells it to the ultimate buyer. And so step one essentially is just establishing a name for the trust, establishing if your deal qualifies. We would sit down and see, do you have $1 million net proceeds and $1 million gain? Is the minimums? The timing of the sale. Do we have enough time to establish the trust inside of the purchase and sale agreement? Of course, work with your legal and financial team, and work with our financial team that we work like with Jake Carpenter to basically just get a framework in place. But you say, I want to do it. You pick the name, we establish the trust, and then we weave language into the purchase and sale agreement or the APA agreement. Or if you're selling stock or crypto or something else, then we're actually going to open up an account where the transfer can happen. And so those are just some of the steps. We have a full-time transaction coordination team that helps do a checklist with everything and just really is detailed. There's a promissory note agreement, which basically states this is the amount that was received from the trust that was due to the owner or the seller. And now you're the creditor and you're receiving a promissory note for that. And then the sales actually takes place. And if you're working with a real estate group, well, I'm also a commercial real estate broker in California, and also going to be here in Florida, where we work to make sure the parties understand what's going on. That's the other part about this too. It's one thing to know about it, another thing to help execute it on each level. So there's the real estate professional, there's the M&A attorney, there's the business broker, there's the financial advisor, there's the CPA, there's title and escrow, there's the buyer who's buying it. A lot of moving parts, but at the end of everything, the trust receives the funds that would have been due to you. You receive a promissory note, and then simply you report that you did an installment sale with the trust. We help you with that. The tax team will help your CPA report it properly. And then as you receive payments, you pay tax. And so that's hopefully what you were looking for on your question, but feel free to unmute yourself and ask more clarifying parts of that. Jake, you want to add anything to that?
Yeah, I was going to jump in real quick and just say, when it comes to setting up the trust, everyone's in different situations. So if you're not sure, or you just are dead set on wanting to at least try a 1031 exchange first, there is a transition that I would recommend that could lead you into the trust if your 1031 fails. So if you're really wanting to try a 1031 exchange first and find that perfect like kind property that may be out there, please work with us, because we have friendly 1031 QIs, or qualified intermediaries, that can work with us to put you into a 1031 exchange. And if that 1031 exchange fails, you can then defease into the deferred sales trust, where you maintain tax deferral. But you
Absolutely.
you have to set that up ahead of time, so that you have all your options and your emergency parachute packed in with your other.
Absolutely. Well said, Jake. Yeah, we can save a failed 1031 exchange. And so essentially, you have a vision for where you want the wealth to be, right? You recognize you have a big problem. You're going to pay a huge amount of tax, right? And number 3, you're going to build a strategy or strategies. And number 4, you're going to build that team. And then we're going to go to work to execute this business plan, and then post-sale manage the capital and invest it in a way to get you the money back plus a return. The next question was, where is the tax savings here? So tax savings is probably not the right word. It would be tax deferral. So think of it like an IRA or 401k, or even a 1031 exchange. None of those are tax savings in the front end. They're all tax deferral. However, when it's inside of the trust on a year-to-year basis, if it's not paying you, then you are saving from paying tax in that given year. Or in other words, you're deferring that tax and allowing that money to help grow the wealth in the trust. Your interest rate is typically 6, 7, 8, or 9% compounding. Net of fees is the goal, not a guarantee to go make the money. And you're receiving payments slowly over time, paying tax over time. So it's not tax savings. However, if you do partner with the trust and establish a new depreciation schedule, we call this next strategy tax flow. Tax flow is the art and science of buying assets that produce loss or paper loss that allow you to offset cash flow, which makes your overall wealth plan more efficient. And so, for example, let's say you're selling a tech company stock, something has 0 depreciation left, multifamily property, and the 10 million goes into the trust. The next day, you use 6 of that to go buy a $15 million property. Well, that $15 million property has a brand new depreciation schedule, of which it produces some tax flow, especially if you do a bonus depreciation, accelerating the depreciation in a year or two. And that's some loss there, which, depending on how it's structured, can produce some tax savings for you, depending if you're an active real estate professional and a number of other things. And so, yeah, there's some real tax savings that can come from depreciation and loss, okay, on hard assets. And so hopefully that makes some sense there. And again, we would have used the money that you would have paid a tax anyways. And so I guess secondary, there is tax savings with this. The last tax savings would be eliminating the estate tax. And so if you're ultra high net worth, meaning your net worth is greater than 24 million married or 12 million single, or in 2026, cut that in half, about 12 to 14 million married, 6 to 7 million single, then we're eliminating the estate tax, right? Which is huge, which has nothing to do with a stepped up basis, has everything to do with your total net worth at the time of death that is inside of the taxable estate, above and beyond the exemptions. It's 40% death tax. I'll give a quick story on this. I have a dear client. I helped her sell her multifamily property in Sacramento. She has another about $17 million of multifamily and business and properties in the Silicon Valley. And for her, she's like, her whole plan was, well, I'm just going to, I'm doing fine, cash flowing, great, not a lot of debt, all these good things. But I said, well, if she's single, I go, well, what's your plan for your estate tax? And she goes, oh my gosh, wow, well, I thought the exemptions cover it. I go, well, if you live another, basically about 2 more years, that's going to cut in half. And now you're going to be, that 17 million could even be 20, 25 million by that point. And I asked her, how much inside your taxable estate? She goes, all of it. And I said, well, guess what? If you were to pass away in 2026, then you're looking at 40% death tax on basically, let's say it's at 25 million at that point, minus the 6 million exemption. That is a lot of tax. It's 40% on 19 million. She goes, well, doesn't the stepped up basis just cover that? I said, no, it covers capital gains tax, but not the death tax. It's something that's separate. And so if you're listening or watching this, you want to make sure you clearly define what your problem is with tax. The government has a spending problem. It's $32 trillion, which means we all have a tax problem. Okay. And if you're looking to create and preserve your wealth and build a legacy with your wealth, you've got to have professionals, you got to have strategies, you got to plan. And that's why we want to encourage you to take action so that you can get some of that tax savings as it pertains to the estate tax. Yeah, it does take it when you die, but your heirs wouldn't have to pay that 40%. It's a powerful way to get that estate tax savings. You can go to capitalgainstaxsolutions.com if you want to learn more. Okay, Yulia, great questions. Any more questions or thoughts on that, or anyone else? You can unmute yourself. You can put it in the chat. We would love to discuss all of this with you right now. In the meantime, who's using AI to do stuff like ChatGPT? Wow, some pretty cool stuff on that. Hopefully you guys are checking that out, asking good questions of ChatGPT, and studying and practicing ways to grow your business with it, because it's a pretty cool tool. Micah, how are you doing? Welcome. We were waiting for you. She is here, everybody. Jake may or may not be joining. I'm not sure. The other Jake Carpenter is here, but Jake Miller may not be joining. But Micah, what is happening in your world? Happy Friday to you. We're talking about the 7 reasons tech entrepreneurs should use the DST.
Wonderful. Yeah, no, the DST is a pretty amazing tool to have in your repertoire as far as options to defer sales tax. So it's an amazing tool.
Absolutely. And Jake Miller, who helps to co-run the mastermind, he's gone today. He'll be back next week. But Micah and Jake are a team, and they're part of the financial advising team. They can help as well, along with Jake Carpenter, which is pretty cool. So, Micah, I'm wondering, what do you feel like is the biggest objection that someone might want to hear on this mastermind? In fact, look at Jake Miller might be coming in, but I'll let you ask that question. What do you think
Definitely.
the biggest? Yeah.
So I would definitely say the biggest objection would be the foreseen loss of control that a person might feel that they have. And because as it stands, you have an asset and you own that asset. And in partnering with the Deferred Sales Trust, you are now a note holder, which is actually a pretty powerful position. But that's probably the number one objection or big thing that people say, oh, wait. I have to think about this and kind of process it a little bit more. But once they kind of get familiar with the stops and the checkpoints and the view access that they have, then they feel a lot more comfortable.
Yeah, absolutely. Well said. And a little edit there. So it wouldn't be partnering with it. It would be actually selling it to it, right? Because if you partnered to be taxable. However, post-close, you can partner with the trust, right? So you got to make sure everything goes in order, which is, I think, so important here, because there's nuance to all of this, right? There's a lot of if-thens, and it's part of what happens to answer the second objection, which is, well, if this is so good, why isn't everybody doing it, right? Well, A, it is nuanced. B, it's proprietary. C, there's not a lot of people who have actually done it, and it's the tax law firm is the one law firm that does this in the country. So it's just not out there. As we all expect a lot of things to be, I guess, chat GPT'd or Googleable, right? Where you could just type it and it tells you everything you would need to know about certain things. Now, AI is getting closer and closer, but there's so many little nuances about things that go into order and when and where. And people would say, well, how'd you figure it out? Well, I'm still figuring it out. I'm still learning every day, but I have a 10,000 hour head start because I worked with the law firm who created it. And I'm a California real estate broker who fell in love with it after the crash of 2008, when friends, family, clients, even myself, were losing like half or all of our money when the thing went down and the 1031s were kind of exploding a lot of people's wealths. because of not enough debt, not enough liquidity or diversification. Long story short, learned about it in 2009. Fast forward, I just fell in love with what it could do for clients, and it could avoid that big pain. And so we're trying to help people now avoid pain as well, especially given the $84 trillion that's set to pass from the baby boomers to the millennials in the next 20 years, the largest wealth transfer in the history of the planet. And we also believe beyond just the finances and all the numbers we're talking about here, this is all of an opportunity. And now you're on the hook as well, because you're hearing this. You can't unhear what you just heard, right? We have the ability to, I think, change the landscape of freedom in America. And it's not just deferred sales trust, but it's every tax professional, real estate professional, financial advisor, understanding the nuances, because guess what? This is what I call the reverse Tea Party. And check this out. What happened in the Tea Party, right? They wanted representation for all the money they were paying in taxes, right? And they were, let's just say, maybe barely making it at that point in the beginning of the country. And then they said, no more. Well, now let's arguably the most successful country in the history of the planet. And this wealth has accumulated massively over 200 plus, I think 220 plus years, right? What are we now? Or more. And guess what? It's 84 trillion that's going to pass from the baby boomers to the millennials. It's the largest wealth transfer in the history of the planet. So the question is, how can we make an impact with that wealth? Well, I would think we would probably all agree that no matter what side you vote for, the 84 trillion in the hands of a government who has spent over 32 trillion is not managing the budget very well. And it's maybe not very efficient with the money. It's probably not the best place to be stewards with the capital. However, if it's in the hands of the people, the entrepreneurs, those who are building affordable housing, those who are starting businesses and creating jobs, those who are giving back to causes they believe in most, that make a difference, to have the money accountable, close to home, local, that can make a huge difference for America. And so we believe even just a percentage of that 84 trillion can move towards something like over 3 to 4 million housing units short in the US alone. That can make a big impact for the world. We've got about 20 years remaining on this. I think it's now down to like 17, actually, that is running every single day. By the way, 10,000 baby boomers are turning 65. And there's 77 million baby boomers in the US alone. So if you are a baby boomer, we are here to help you think through your options and hopefully build some know, like, and trust with us as we're even talking right now, so that you can exit in a way that has a legacy, has an impact, and gives you the freedoms from feeling trapped by capital gains tax and estate tax. Again, if you want to learn more, you go to capitalgainstaxsolutions.com. That being said, I want to bring in Jake Miller. Jake, how are you doing today on this Friday?
It's a fantastic Friday, Brett. In fact, we should call it the effing Friday, just because having a fantastic time and can't believe it. I apologize for being a little bit late. I was with some of our mutual clients who have a deferred sales trust. We were establishing their investment allocation. And just as an example, so that everybody here knows what is possible, they chose a bottling and co-packing plant as an investment within their DST. They chose a dynamic risk portfolio inside of the market in marketable securities. They chose to invest in a casino, and they chose a short-term debt fund, like a short-term private debt fund, not in marketable securities, something that is paying them stable, consistent, low risk, collateral backed, and things that are available sometimes only to people with a DST or people who are accredited investors or qualified clients. And so we bring that to the table thanks to Brett Swartz, thanks to the Deferred Sales Trust, and we help clients accomplish things that they didn't even know were possible simply because they're now eligible, that they have money and they have assets inside of the Deferred Sales Trust.
Jake, I just so appreciate that. Thank you for the always the kind words and the vote of confidence. And also think about this. We also want to thank the government. We want to thank you, Mr. Government, for not only giving us all the freedom and all the stuff that we have. We're so blessed by that, but it also brings us all together, right? To be honest, without the tax problem, we're not even here, right? So, and we want to be grateful for what it is, right? There's a big tax problem, but we're here to take that. And by the way, you might ask, well, who actually wins the most here? The government actually does win the most. Why? Because they want tax revenue, of course, right? They want more revenue to do more things, which is a good thing when they're doing the good things with the money. But how do you create more revenue where you incentivize people not to just go spend all the money or put it under their mattress? You incentivize them to put it into tax efficient vehicles that are doing what? They're investing into the economy, that are building housing, right? Why do they give such great depreciation on multifamily assets? Because they want to create housing. Why is it 27 and a half years versus 39 years? Because somebody smart back in the day, I don't even know when they changed that, said, you know what, why don't we incentivize more people to build multifamily by squeezing the schedule to 27 and a half years versus 39 for commercial property, right? In fact, it would be wise to maybe squeeze it to 15 years because what? It creates more tax flow, which is more incentive for developers, business, and entrepreneurs to go and build the houses and or guess what, the deferred sales trust to start a new business venture. When they start that new business venture, what? It creates more jobs. Creating more jobs, the study of macroeconomics, there's more money flowing. There's more taxes being paid. It's a really good thing, right? So if you're selling and you're wondering, this seems too good to be true, like, why would the government even allow something like this? Well, it's because it actually creates more tax. If you think about it, right? Because once you spend the money, if the money's not invested back into other things, it's not as likely for it to create more jobs, more housing, and then around and around it goes. It's kind of like the flywheel of the deferred sales trust. In fact, I think I'll make a video on that. We'll call it the flywheel of the deferred sales trust. How every single, let's say interested party, the government included, the financial advisor, the trustee, the commercial real estate, private equity firm, how everyone's going to benefit for the taxes being deferred, and ultimately the each U.S. citizen if we can create, more housing, more jobs. Jake, how do I do there? Either Jake,
You did fantastic.
Jake Carpenter or Jake Miller.
Absolutely. I would just only add that not only more taxes, but more GDP. So the government, although they have a lot in debt and they need our tax money like never before, they are also encouraged and incentivized to produce flow of capital and money. And GDP is that cycle. And I think in your presentation you do, Brad, it should be a GDP presentation brought to you by the Deferred Sales Trust and something that keeps the cycle moving.
Yeah, versus the stagnation of the money, right? We had a client in Palo Alto who had a $8 million plus house. Kids are out of the house. He's now single. A lot of his capital is held in this house. He's in this huge house on University Avenue, massive house. He's like, Brett, I have all this capital in here, not any cash flow, and the money's, just in my big house. He goes, I want to retire. Can I go use the DST? And the answer is yes. You can use it for a primary home. And then can we invest that into marketable securities? And we did, which is guess what? Going to create hopefully more jobs as these companies have more capital to grow their companies. And so that's the power of the deferred sales trust, or even cryptocurrency, right? Or stock, highly appreciated Apple stock that you can unlock, defer the tax, and then invest, right? And get that money replanted into things that could grow the GDP, grow your cash flow, hopefully grow your freedom, and most of all, hopefully grow your impact. So we have about 9 minutes to go. If you want to take action, you can go to capitalgainstaxsolutions.com. You can schedule a one-on-one consultation with myself or one of my team members. Also, if you want to connect with Jake Miller, you go to strategictaxsolutions.com. He and Micah, strategictaxsolutions.com. Jake Carpenter, you can go to carpentercapital.llc. You can also subscribe to our YouTube channel to watch this replay by going to Capital Gains Tax Solutions YouTube channel. As well, we have the Expert CRE Secrets YouTube channel. So we're streaming on both of them. We have our podcast and we've got the book. If you haven't got the #1 best-selling book, please do. We would love your support. I think you're going to love it. It's our my journey to the Deferred Sales Trust. And it's not just me. We have Jake Miller in the book and Kevin Harrington from Shark Tank. So check it out. It's all about helping you to build a proven plan when you're exiting, so you can establish and grow your wealth. Everything we're talking about today. That's all I got for today. I gave it my best, everybody. So you got questions for me? Toss them up because we've got about 3 minutes left, and then we're gonna say Happy Friday, and we're gonna all go our separate ways. So,
Brett, can I chime in really quick there?
Yeah, Jake Carpenter, go.
So we had a question pop up. I want to make sure I address. I don't know if she's still with us. According to fees, asking about some fees. So basically, if the deal qualifies, it's 1.5% on the first million, so 15,000. 1.25%, anything above that. Deal's large enough, we can usually kind of negotiate on fees depending on if it's 15, 20, $30 million or so. There are some other fees associated with that too, but that one-time upfront fee covers lifetime audit defense by the tax attorneys for the life of the trust. So should there be an audit, they will defend it at no expense to the note holder. There's a little bit more to it than that, but we're short on time. So Brett, back to you.
Very well said. And then, there's the trustee fee, financial advisor fee, collectively about 1.5% to 2% on a recurring basis. The goal is to net you 6, 7, 8, or 9 net of those recurring fees. So let's just say you put $1 million into the trust, deferred 400,000 of tax. You pay 15,000 one time to the tax attorney, and then the trust would pay about 15 to 20 on a recurring basis. But our goal is to net you, let's just say on 8%, 80,000 per year cash flow on that $1 million. Right. And then you'll pay tax on that. And that would be ideally net of fees. Nothing is guaranteed. We have to go invest the funds, and it's over a 10-year period typically. And you can renew every 10 years for 10 years, pass it to your kids via the living trust on the DST 1.0. With the 2.0, your kids are the beneficiaries outside the taxable estate, a little bit different there on the payout. All of those details you can find out by having a customized consultation. You just have to have a deal. This is a $1 million net proceeds, $1 million game. Go to capitalgainstaxsolutions.com. Okay, I think that's it. I appreciate everybody. Thank you so much. And we look forward to being here next week as well. Every single Friday, 10 a.m. Pacific time, 1 p.m. Eastern.